Welcome to Market Movers. I'm Dave Hightower, joined by Dan Bosse. So Dan's setting the table here. We look like we're going to trim down this excess supply a little bit. The question is how much. We got corn, good to excellent ratings at only 56% compared to the average in last year. There's some problems. How bad are they?
Well, there is problems, David. We know this crop was the latest planted on record in terms of the Midwest in both corn and soybeans. We know there was a lot of acres still emerging as we get into the end of June and early parts of July. So it's a very latent crop. That's why condition ratings are down. But we also, as we look forward to this July report, we got to understand that the USDA may be using and likely will use those seedings estimates from NASS that came out on the 28th of June. That was 91.7 on corn and somewhere like 80 million acres on soybeans. So that'll be the focus point, at least as we head into the end of the week.
Big numbers, big variations, so big price swings.
Yeah, we're going to see continued price swings because the volatility on this crop this year is the corn crop likely is around 14 billion bushels. Maybe soybeans somewhere in the vicinity of 4.1 or somewhere under that will be large. In other words, the skews from Mother Nature going up and down in terms of weather and what it really means to the crop will be very important.
And corn continues to be the front runner. There's the focus on them. The beans kind of a backseat, but that could change, couldn't it?
Well, it could change, but again, remember, we've got a lot of trade issues that are still ahead, and it's very unlikely that we'll resolve these trade issues heading into the end of the year or maybe even heading into the presidential election next year. So those trade issues will persist. I think you're right, though. Corn is the big behemoth here in terms of importance for the market and where do we go longer term.
Very good. Well, before we dive into our trade discussions, I'd like to point out that these trades are examples and not recommendations or advice. So Dan, set the stage.
Well, David, I'm looking for the report maybe to be slightly negative, but in saying that, I think weather and crop concerns are enough to keep this market well supported. My example is I'd like to sell in August $8.60 soybean put at 7 cents. I'm going to risk 4 cents to collect the entire premium. That contract expires before the end of the month, so I think there's good opportunity there.
Get a little bit of time decay and rest on solid value in the market. So Dan, as an example, I'm looking to buy September corn, $4.60 short-dated new crop call, 12 cents with an objective of 39 cents and risk a total of 8 cents from entry. Again, looking at that new crop, expecting that eventual loss of supply to be revealed in the marketplace.
Well, I think that along with weather, David, heading into pollination, which is now delayed 30 days into early August, I think that call makes good sense.
Excellent. So Dan, on Market Movers, we like to educate new folks just tuning in, and this time we want to talk about crop conditions readings. How are they derived and what do they mean?
Well, crop condition ratings are a beauty contest. These are people that run up and down roads or USDA enumerators that look at crops and have broad opinions in terms of how they compare year after year. So if we have a crop that maybe, as you say, 56% good to excellent, well, that puts us in the lower skew of where we've been in the last decade. But again, remember that the correlation between condition ratings and yield is not strong. It's the main reason why USDA does not use it within their what I would call reports in August or September.
But without them, all we have is anecdotal information.
You've got it right. And so it's a beauty contest. As long as we understand that, we're all good.
So thanks, Dan, for your insight. We'll keep a close eye on the market. Thanks for joining us on Market Movers. I'm Dave Hightower. Trade well and trade smart.